And I'm going to welcome the attendees who are still coming in to this webinar hosted by the IIM and McLean Partnership, which takes a look at the economic outlook. I think the title was Less Inflation, More Growth. I'm delighted to be joined by Darren and Nick from McLean, and I'll leave them to introduce themselves. Just a couple of housekeeping points from me. The webinar is being recorded. The recording will be available afterwards on the IIM website. We've launched a poll here, so please take a moment to fill that in. And I see that a number of you are already doing it, which is great. Thank you very much. We'll launch another one partway through the webinar. We'll probably have a commercial break just to tell you a little bit more about the work of the IIM for those that are interested. But please nip over to the website and have a look. My name, for those that don't know me, is Bruce Rayner. I'm a volunteer in the IIM, which is run by Interims for Interims. So again, go and have a look at the website. There's lots of information on there for those of you that are non-members or are not familiar with the work of the IIM. So without further ado, I'm going to hand over to Nick and Darren, who hopefully you can all see on your screen, and we'll get cracking. Nick.
Thank you, Bruce. Good afternoon, everyone. I'll introduce McLean and then Darren, who will be doing the bulk of the speaking today. So McLean Advisory, for those who don't know us, is a professional services consulting platform with companies operating across executive search, recruitment, economics, and HR advisory. We offer market-leading strategic advice to people and companies within commerce, industry, financial services, government, public services, academia, and innovation. I lead our interim and consulting business for our executive search business, the McLean Partnership, and Darren, alongside me, is a senior partner in the Lazarus Partnership, our economics and strategy arm, which provides a rigorous and detailed analysis of a broad range of indicators across major economic geographies. Darren has over 30 years' experience in the financial markets, working as an economist and strategist within the Bank of England, SG Warburg, UBS, and JP Morgan. Darren will now speak for 30 minutes. We will then have some Q&A, and I hope you will enjoy the presentation.
Thank you very much, Nick and Bruce, and thank you for people joining us. So I'm going to spend a bit of time looking at what's going on in the UK economy, what it's been doing, how it's likely to develop going forward. And I thought I'd just start by looking at how it's doing relative to the other major economies, because I often hear commentary on the economies to suggest that it hasn't been doing very well relative to the other economies. And yet, when we actually look at the facts, we find that that's not actually the case. If we look at the period since pandemic, the growth rate of the UK has been pretty similar to the other major European economies, but below that of the US. When we look at the period since 2010, which is a popular reference period at the moment, we see that only the US has grown by more than the UK over that period. So I think sometimes the economy gets not as good a write-up as it should do based on the actual numbers. Now, we've got this sort of monthly estimate of GDP in the UK, which is, you can see here, it's quite volatile. It doesn't often do the same thing from month to month. But it's been sort of treading water for the last 2 or 3 months through the third quarter. The economy grew by more than it was expected in the first half of the year, but it's lost some ground in recent months. Now, if we'd been doing this call a year ago, the consensus view a year ago was that the economy would be in recession. in 2023, and that it would shrink by about 0.75 percentage point. As you can see, the economy now clearly hasn't been in recession this year, and it's now expected to grow by about 0.5% this year. But the consensus view for next year is that, yes, inflation is going to halve, but the growth rate will be the same in 24 than it was in 23. And I'm inclined to challenge that consensus in the same way that I wanted to challenge the consensus a year ago. And I think, you know, often it pays to challenge the consensus thinking. Now, if we look at the Bank of England's thoughts on the economy a year ago, they were projecting the longest recession in history. So not just a recession, but a long recession. And since then, they've sort of changed their forecast quite a bit. They too now think that growth will be 0.5% in 2023. But the table just at the bottom there shows you that they don't expect the economy to grow at all in any quarter in 2024. They've got 0, 0, 0, and 0, which statistically would be an unusual outcome. But you know, unusual things, you know, do happen. So you know, we should always be, you know, open-minded about any of these outcomes. And you know, forecasting is not straightforward. On inflation, you know, they're reasonably confident that inflation will come down to the target, and they have been confident in that for some time. And of course, we have now got inflation below 5%, whereas a year ago it was over 10%. So we're going to get an update from the OBR next week with the autumn statement. This is the spring budget. So in the spring, the economy was expected to contract by 0.2% this year. As we said, it's actually grown by about 0.5%. And then from sort of 24 onwards, the view was back in the spring that the economy would actually grow by about sort of 2% or thereabouts over the medium term. So quite a different projection from the one we've just had from the Bank of England. And it'll be very interesting to see what the OBR's projections are next week in the autumn statement relative to what they were thinking in the spring. My sort of suspicion would be that they'll be quite a bit less optimistic now than they were then. And that will, of course, make it more difficult to do some of the things that the government would probably like to do going forward. And of course, this is going out to 2027, and there will be a general election at some point between you know, now and over that period. So I think that the tricky thing we have in sort of projecting the economy at the moment is that there used to be this quite sort of nice relationship between bank rate and mortgage rates. So when people didn't have fixed rate mortgages, we could look at bank rate. We could say, okay, bank rate is X, the mortgage rate will be X plus something. And it's got a bit more difficult now, because now we've got nearly 90% of the mortgages are fixed. So the bank rate goes up, and you can see it has gone up, it's gone from 0.1 to 5.25. So we know that if we go from 0.1 to 5.25, something's got to happen. But the mortgage rate, of course, hasn't gone up very much at all. So this is on the stock of mortgage loans. So this grows up very, very slowly. So if we'd looked in the past, just on this sort of scatter chart, if you like, and said, well, okay, bank rate's 5.25%, where would the mortgage rate be? You'd say, well, probably about 5.5. But at the moment, it's just over 3. So, and it's only 3 rather than 5.5 because the mortgages are fixed and they take time to refinance. And most of them are fixed for 5 years, so it takes quite a long time for the full effects of what the MPC have done with interest rates to actually come through into the mortgage market, let alone for the rest of the economy. So, you know, you're likely to be making probably larger than normal errors in your forecasts, but you've still got to try and make them. So at the moment, this rate's going up by about 10 basis points a month. And we get these numbers each month from the Bank of England, and they tell us what the rates are, and the rates on the floating rate mortgages are over 6, and the rates on the fixed rate mortgages on the stock are still under 3, but of course on the new loans they're about 5, and these rates continue to move. So now, of course, when we're trying to sort of analyse what is the effect of this actually going to be, we've got to start with saying, well, how many people have actually got a mortgage? So if we're looking at owner-occupier mortgages here, not the so this isn't including buy-to-let mortgages. So for owner-occupier mortgages, it's about 2 million less than it was at the time of the financial crisis. And I think the reason for that is that since the financial crisis, it's become more difficult to get a mortgage. And as it's become more difficult to get one, fewer people have been taking them out. So whereas banks used to sell well over 100,000 mortgages a month, now they don't do that. So, and then when we look at the number of owner-occupier mortgages as a percent of all households, we think, well, only actually about a third of households have got a mortgage. The other 2/3 who have paid their mortgages are for their private or social renting. So then when we look at, well, okay, so the number of people with a mortgage is quite a bit less than it was before. Not that many households have a mortgage proportionately, and those that do have predominantly fixed them because they like the comfort of knowing what their payments will be over 2, 3, 4, 5-year periods. So when we look at the actual amount that's being spent on mortgages, so we take the stock, about £1.6 trillion, then we apply the mortgage rate on that stock to get to the number in pounds. Now we're assuming here that it's all 25-year mortgage terms, interest and counting. Now, of course, in reality, it isn't, because some of them are interest only. So, but this I think is a reasonable simplification. So when we look at those payments, they've only recently got back to where they were during the financial crisis. And of course, since the financial crisis, household disposable income across all households has gone up quite a bit. So when we look at those mortgage payments, what they're actually taking out of total household disposable income is quite a bit less now than it was at the time of the financial crisis, which I think is an important point. Now, when we look at the stock of mortgages, what we're finding is that this is a series that has never gone down. We've never seen a decline in the actual stock of loans until the second quarter of this year, when it went down. Now, it didn't go down by very much. And it went down because the new mortgages slowed right down, but also banks were coming across customers who were paying down some of their mortgages they refinanced, particularly given the jump in payments. So we're not seeing much growth now in the stock of mortgage loans, which of course is helpful from one perspective, because it means that it limits the increase in payments. So the first thing we've got to try and do is say, well, what is actually going to happen to interest rates going forward if we're trying to look at what's going to happen to the rates that people are actually paying? And we look at these market interest rate expectations. Now, the market is constantly changing its mind about interest rates. So when they started raising interest rates back in December 21, the market view was, yeah, they're going up, they start at 0.1, they'll probably go up to about 1.25%, and then that's basically where they'll sit. Now, it's sort of hard to believe that ever was the expectation, which is end of 21 is not that long ago. And then, of course, things changed. Inflation turned up, got to quite high levels, and the market started to get quite pessimistic. So in the summer of this year, the market started to think, oh, interest rates could get to 6.5%. Some economists were predicting even higher levels than that. Now, interest rates haven't got to 6.5%. And I should say that the interest rate markets are not very good predictors of what interest rates actually do. We should always keep that at the back of our mind. So rates have got to 5.25%, and the current expectation is that rates will fall to around 4% by the end of 2025. But these expectations do change quite frequently. So my working assumption in the numbers that I'm presenting to you today is that all mortgages will refinance at between 5 and 5.5%. Now, as I'm looking at the market rates at the moment that are being offered by the major lenders, that's probably too high. But I'm going to sort of persist with it for the time being. So if I use that assumption, so that by the end of 25 going into 26, the interest rate on the stock of loans would be up to about 5.25%, from about 3.25% at the moment. And then I put in some, what I would consider to be reasonable projections for disposable income. I can update and extend the line we looked at a couple of slides back and say, well, yes, the payments are taking more out of disposable income than they are at the moment, but it's still much less than it's been in the past. So what I'm really saying here is that the macro economy is able to accommodate these higher borrowing costs, perhaps a little with less difficulty than perhaps is often suggested. Now, of course, what you've got out there are different groups of people. On average, pay's gone up by about 7% this year. So if you took a household that had the average mortgage of about 150,000, who's had a 7% pay rise and didn't have to refinance their mortgage, their cash flow could be up 10% this year relative to last year. If we took another household who also had a 7% pay rise but did have to refinance their mortgage, this year their cash flow could be down 8%. So we've got different groups of households out there. And of course, what we have to try and do, what I'm trying to do, is look at what's the macro outcome. Because we can't look at each individual household. We've got to look at what's the overall macro outcome from all of these various moving parts. And I think what the economy has shown this year is that the outcome is not as negative as was thought this time last year. But of course, there are plenty of gloomy thoughts around for next year at the moment, based around similar sorts of considerations. Now, clearly the labour market is important in all of this. Now, you know, we've got some things going on with the labour market data at the moment. They're not quite sure how reliable some of these numbers are, but if we just take what we've got, then employment is almost back to where it was before the pandemic. The employment rate is still low because we've had population growth over that period. If we just look at the number of people that are on the HMRC payroll, so we're not including self-employment here, then the number of people in paid employment is about 1 million higher than it was before the pandemic, at over 30 million. Now, I think this data is certainly more reliable than the labour force survey data because it is based on actual payroll numbers. So I think we've all sort of warmed to this series in terms of something to look at to give us some guidance. So, but you can see there it's leveled off. And I'm sure many of you will have had a similar experience to this and are observing this in your day-to-day businesses, that demand growth is softening. And we've seen the unemployment rate increase as a result of that. So unemployment got down to near 50-year lows in the summer of last year. It's still very low by historical standards, but it has risen by about 250,000 since last summer. A lot of that's been in the 18 to 24 age group, a lot of students coming back to the labour market who perhaps left the labour market through the pandemic. We do have quite high graduation numbers each year. So the unemployment rate for that age group, the blue line has gone up, you know, quite a bit over the last few months. So we're currently at about 4.25%. If the participation rate, number of people actually in the labour market, was the same now as it was before the pandemic, the unemployment rate would be about 5.5%. So we need to sort of calibrate our thoughts on that, and the 5.5% would be the sort of long-run average for unemployment. That's where the unemployment rate has typically been. So I've broken this down by age group because I think one of the things that we've seen in the labour market over a long period of time is that as the population has aged, participation rate for older age groups has generally gone up. But of course, it's gone down since the pandemic as people in that age groups have left the labour market but are generally coming back. But I think the blue line is probably is perhaps a bit more interesting. Is should we really be thinking about higher participation rates for the 18 to 24 age group if we're thinking about getting more economic growth into the economy? Those participation rates are lower than they used to be, and should we be trying to encourage more people in that age group to be in the labour market, and perhaps not so many in education? Something to think about, I think, going forward in terms of promoting economic growth. So vacancies, which were very high through last year, peaks just after the spring, have come down by about 350,000, but they're still quite high. They're well above where they were before the pandemic. A normal level of vacancies is still lower than where we have at the moment. But as the unemployment has gone up as well, the vacancy unemployment ratio, which is something the Bank of England put quite a lot of weight on in terms of measuring labour market tightness, has come down. So the labour market is still tight, but it's less tight than it was. And that will, over time, start to ease the wage pressures that we saw in the labour market through last year. So those pressures are generally starting to ease, but they're still quite high. Wage growth is still 7–8%, and that's well above where the Bank of England would like it to be, which is more like 3 to 4%. So we went through a period where real wages were falling, quite sharply through 2022. And now we've seen with the numbers this week that wage growth is now above inflation, so real wages have started to grow again. Now the table at the bottom here just puts in my sort of projections. So I've got wage growth slowing to about 4.5% between now and the end of next year, and inflation slowing to around 3%. So real wage growth is around 2% for the rest of this year, first half of 24, and then slows in the second half of 24 because wage settlements get restruck, and they get restruck against a much lower headline inflation rate, so the settlements come down, but they stay above inflation for a period. So I think that's a positive support for economic growth in 2024, because we're going from falling real wages to rising real wages, and I would expect that to drive more economic growth rather than less. And then another sort of thing that we've, I guess we didn't spend too much time talking about before the pandemic is what's happening to bank accounts, money in the bank. So for households, that's gone up a lot. Went up a lot initially because people were being paid to not go to work and the shops were closed, so they had to save more. It was unplanned saving, and most of it ended up in bank accounts. And it hasn't really come back. It's leveled off, but it hasn't come back to where it was before. And I think more importantly, it's households have more than 200 billion more in deposits than they have in loans. Compare that with the financial crisis when they had 300 billion more in loans than they had in deposits. So the banks are awash with deposits now, whereas in the financial crisis they were very short of deposits, and ended up paying quite high rates to get more deposits at that time. So crudely, if we just take the bank deposits and the interest rate that banks pay on those deposits, which on average at the moment is about 2%, that's a weighted average of all the current accounts, savings accounts, some are floating, some are fixed, and so on. And that's gone up by over 30 billion since they started raising interest rates. And then on the mortgage loans, which haven't risen very much since they started raising rates, the payments have gone up by about 15 billion. So far, the increase in interest income is much bigger than the increase in mortgage payments. So the effect of increasing interest rates has been to actually put more money into the economy in this sense. And of course, there are other ways in which interest rates affect outcomes than has been taken out. But of course, over time, this will change because the mortgage rate will keep going up as people refinance, and the deposit rate will stop going up. So when we get into 2024, what has been, a meaningful tailwind, this year will turn into something of a headwind as we go through 2024 and into 25. Now, I suppose what's slightly curious, and this has been a different experience in the UK to the US, is that the amount of saving that's being done in the economy has actually gone up since inflation went up. So it's strange that during the cost of living crisis, that the aggregate amount of savings has increased. So if we thought that households had been planning to save around 5.5% of their take-home pay, which is what they were doing before the pandemic, and then we look at what they've actually saved since the pandemic, the unplanned saving, and this is, is over £300 billion. So there still is quite a lot of spending power out there in the economy. Whereas if you looked in the US, for example, the saving ratio has come down to 4%. So the saving ratio in the UK at the moment is currently over twice what it is in the US, and that's why the US economy is growing more quickly than the UK. So then we get into another discussion on inflation. So inflation averaged 9% last year. That was 3 times higher than it was forecast to be at the beginning of the year, and was the highest since the early 80s. And you can see here, it's coming down as fast as it went up. And this is what it tends to do. Although there was discussions, inflation is going to be sticky, it went up fast, but it will come down slow. I think we'd all agree that on that chart, it looks like it's doing pretty much the same thing down as it was when it was going up. And of course, what was really driving it, I think, as you can see here, is energy prices. So we saw these huge increases in energy prices, mainly driven by gas, but oil also played a role. And although energy accounts for less than 10% of the inflation basket, it accounts for most of the volatility in inflation. So we tend to pay a lot of attention to what's happening to energy prices. And because gas and electricity prices are only reset every 3 months with the energy price cap, they can get held up for a while, which they had been, but eventually they catch up. So energy prices are down about 15% from their peak in November last year, but gas and electricity prices are still 65% higher than they were before the pandemic. So, there's still a very high level of energy spend out there, as you can see on this slide. But whereas gas and electricity was boosting inflation by about 4 percentage points, so almost half of the inflation was coming from gas and electricity, now it's taking 1 to 1.5 percentage points out of inflation, and will continue to do that for a while until we get the energy price cap set again. So energy's really done its thing now in terms of the inflation arithmetic. So we've gone from 11 to 4.6. Energy won't make much more of a contribution from here. So, but food still will, because food price inflation is nearly 10% of the inflation basket. Inflation rate was 20, it's now 10. And you can see there, food price inflation is also falling as fast as it went up. And food prices have basically been flat for the last 3 or 4 months. So we're going to see further reductions in overall CPI inflation just from food alone. Another factor that will bring inflation down, motor insurance premiums are up nearly 50% at the moment. They won't keep going up by 50%, so there will be a base effect from that next year as well. And we've got negative input and output price inflation. So the cost pressures that companies have been facing have eased significantly over the last 6 to 12 months. So the input price inflation is currently negative, as is output price inflation. Ultimately, that drives CPI inflation lower as well. So these are my best guesses. for what will happen to inflation through 24-25. So it comes down a little bit more over the next couple of months, and it falls further through 24 and 25. So we get back to 2% at the end of 25. Now, this forecast won't be right. Not many forecasts are. And I would say the risk on this is that the numbers will probably be lower than I've got in these in here, and that inflation will be down to 2% more quickly rather than more slowly, because that just tends to be the way these things develop. When inflation goes up by more than you thought it was going to go up by, and then it comes down by more as well. And that's what we've sort of been seeing in the US. So then housing is always an area of interest for the UK economy. These are the Land Registry's numbers on house prices, and they show that house prices actually haven't fallen very much. And in fact, over the last few months, they've been going up, which is hard to believe, but that's what the numbers show. If we look at real house prices, they've dropped 6 to 7% from their peak last summer. But the peak last summer was no higher than the peak in 2008. So we went through a long period of time when real house prices actually hadn't gone up. If we compare the fall in real house prices now to what we saw in 2007 and 1989, again, most recent numbers look a little bit odd in this context, but they're falling at a slower rate than they have done following their previous peaks. Housing transactions are also being more resilient than people generally expected, and mortgage approvals look as though they're bottoming out as interest rates start to ease. When we look at affordability for first-time buyers, it's not as bad as you might think or it looks, because if you look at the peak that we're seeing now, it's well below the peaks that we saw in the past. So yes, affordability has deteriorated significantly, but there is nowhere near the stress in the housing market now that we've seen in the past. So I think we should just sort of bear that in mind and not get too pessimistic about the outlook for house prices or transactions. When we look at the public finances, because we've got the autumn statement coming up, got to some very high deficit numbers during the pandemic, but those numbers are starting to come down. Taxes are quite elevated as a share of GDP because spending is elevated as a share of GDP. So the only real way you can bring taxes down as a share of GDP is to bring spending down as a share of GDP. Otherwise, you're just increasing your borrowing all the time, and that doesn't work. So this is something that people probably want something done about in terms of taxes are too high as a share of GDP, 40%. They haven't been there for quite some time, and there probably is an ambition to get that number down. But again, to get that number down, you have to try and bring this number down as well, which of course is not easy to do. The good news is for this financial year, the budget deficit is 20 billion less than it was forecast to be. So for this financial year, the budget deficit is likely to be materially lower than was forecast in the spring budget. And the other good news is that debt interest payments are falling sharply now because RPI inflation, which has all the index-linked gilts, is falling sharply. So the fiscal situation is not as problematic as perhaps it might seem, but government debt is very high. It's nearly 100% of GDP, and that's much, much higher than we've seen in the past. So conclusions really, in summary, there is a lingering headwind from higher interest rates because we can't go from 0 to 5 without entailing those headwinds. Those headwinds are an impact on the economy. They are holding growth back and have been and will continue to do so. But there are also tailwinds in the economy as well, particularly coming from a recovery in real wages in 2024, and probably also at some point, some tailwinds being generated by the government itself as the fiscal situation continues to improve. So I would be more optimistic than the consensus, thinking about the economy going into 2024, because inflation has halved, it will probably halve again. That will create a period of rising real wages rather than falling real wages. And interest rate pressures are easing, and it is likely that there will be some policy support fiscally coming into the economy at some point next year as well.
Thank you, Darren.
I'll leave it there.
So I think we're going to open up to some questions. I think I might start by asking you a question pertinent to the audience here. Don't worry about the poll on the screen. So the recruitment market, especially the interim management market, is often utilised by businesses that want to move at speed, either to make changes in difficult times or to take advantage of opportunities in better times. And the economy you've articulated just there is one that might have scenarios pertinent to both. If we look at the recovery from the crash in the economy in 2020 and the better market we all experienced in 21, should our audience be optimistic of a similar level of recovery?
Well, look, I think, you know, we saw a 750,000 drop in employment in 2020. You know, there was something to recover from then, and I think with the benefit of hindsight, probably a lot of companies reduced their workforce by more than they perhaps, with hindsight, wish they had done, because the economy rebounded more strongly than was expected, and that continued. Now, I think what we've seen over the last few months is the labour market has just levelled off. We've already generated 1 million more jobs in paid employment than we had before. So we're at quite a high level of utilisation in the labour market, and it's softening.
Yeah.
And the supply growth is increasing as well. So softer demand, increase in supply, lower wage pressures. So look, I think the economy is going to get off to a slowish start in 2024, but as the fall in inflation becomes more fully established and the recovery in real wages becomes more fully established and consumer confidence and so on improves, then I would expect the economy to build momentum during the course of 2024. So the numbers of, if we say the economy is basically flat now, the labour market's basically flat now, that's probably going to continue in the early part of 2024. But you actually build momentum through the year.
Thank you. And then a final question for me on the basis of that is, what could the government be doing? Talks about it a lot, to promote more economic growth.
Well, I mean, I think the government has been right to stress the importance of getting inflation down, because it's hard to grow real GDP when inflation's 10%. So, you know, you've got to get that down. And, you know, you can debate exactly what contribution the Bank of England has made to that, or has it just been, well, energy prices just stopped going up, came down a bit, and that's why inflation just arithmetically dropped. And, you know, that is a large part of it. So what the government needs to look at now is, okay, we've got inflation back down, which means that headwind from high inflation is removed, real wages are rising. That in itself will naturally, in my view, generate more economic growth. And then the government needs to think, well, okay, beyond that sort of short term, what sort of things can we do to sort of raise productivity growth over the medium term? Because in the end, you know, real wages have to be pretty similar to productivity. You can't be paying people more than they produce. So although we've got this window at the moment where real wage growth is quite high, we've seen something similar in the US. So you know, they've got to look at ways of sort of freeing the economy up, maybe a less regulated economy, trying to take advantage of some of the things that they can do now that perhaps they couldn't do, you know, pre-Brexit and so on, to generate some energy.
Yeah, thanks. I have many other questions, but I thought I'd ask Bruce if we got any questions from.
Yep. So listen, just a huge thanks there to Darren. I mean, I'm sure everybody found that really fascinating. I know I did, and a huge amount of work there, Darren. So, you know, a big thanks for that. Lots to lots to contemplate. We've got questions coming in. I would urge you all to get your questions in so we can get through those. One from me though, Darren, you mentioned the B word there, Brexit. What's the impact of that, either positively or negatively, as we kind of roll through in time, do you think?
Well, look, I mean, it's like all these things, you know. We'll never know what would have happened if we hadn't have Brexited, if you like. We can only look at what our performance has been, both in absolute terms and relative to others. And it has, I'd say the US out of it, has been broadly similar. The events that have held up growth in the UK have held up growth elsewhere as well. So, we have been growing at pretty similar rates to the other major European economies. Now, you could argue, well, we would have done even better if we'd stayed in, or we would have done worse. And, the counterfactual is something that we can't know. My own sort of personal thoughts on it is that there are large areas of, I think, regulation in the economy that are essentially set by ourselves that, we could have a good look at and say, well, maybe we can do some deregulation of our own, irrespective of any sort of EU consideration in that context. And, I'd imagine that they are doing that, and we might hear some more on that in the autumn statement next week. I suppose my main point really with the slide that I opened with is that we're actually doing quite a bit better than we're often portrayed as doing, because if we weren't, we couldn't have an unemployment rate of 4.2%. We've got very low levels. You can't get to 50-year low rates of unemployment if you're not doing something right. And you can't have these levels of employment if the economy isn't growing or hasn't been growing.
Yeah. Okay, so look, we've got just looking down the questions. We got a couple from, well, one from Alistair, which is pertinent to the audience, I suppose. In respect of UK paid employment, up 1 million with broadly flat total working population, how much of this corresponds with IR35 and the crunching down of the limited company workforce? I mean, is there anything in the data that would give you a clue on that?
Well, what you can see in the data, and I should caveat the data on self-employment from the ONS, because they're currently not producing data on self-employment, but it's down around 700,000 from where it was before the pandemic. Now, there's probably all sorts of factors that have gone into that decline. I think during the pandemic, one thing that you often heard was that if you were self-employed, you could very easily end up not getting much support or help during that period. So a lot of people went back into paid employment, and they've stayed in paid employment since then. So it was a decision that they made during the pandemic, and one for a lot of people just hasn't been reversed. But I think there are other, as you mentioned, there are other considerations that have driven that as well. So, we have to be slightly careful that we don't just look at paid employment, because we've got about 4 million people self-employed, but at the moment we don't know exactly what's happening to that number.
Yeah. And of course, the self-employed workforce ranges from, the executive, interim, and C-suite down to across to the Uber drivers and the Deliveroo guys.
Yes, yeah. I mean, it's a large pool of people, but with an awful lot of cross-sector activity within it.
Yeah. From Andrew then, most of the drop in participation by the youngest population happened before the pandemic by the look of it. Why was that?
Well, I think it's arithmetically, you would look at it and say it was predominantly an increase in the student population. So we've seen an increase in student numbers. I guess you could go back to 97 and the Labour desire at that point to promote university education more than it had been before, higher numbers going into higher education and into further education, which gives you lower participation. So if we're now going to push back towards maybe apprenticeships rather than full-time education, then maybe that will generate higher rates of participation for that age group. It's sort of, you get the sense that that's where policy is heading, but without openly saying that we're actively discouraging further and higher education, because that's probably not the message. But the message on apprenticeships, I think, is coming through, I think, stronger than it has done for a while.
Yeah, so thank you. And a question from John. Hi, John. Often the interim market doesn't reflect the employed market in terms of activity. Do you see this going into 2024?
Oh,
It's a toughie, that, isn't it?
That for an economist, that's a tricky one. Yeah. Look, I mean, I think if you look at if you share my view, which you might not, that we are going to see rising levels of economic activity during 2024 as opposed to declining levels of economic activity, then overall levels of demand right across the economy will be increasing over time. So I would expect that would have an impact across the whole of the labour markets, in all aspects of activity. But there are plenty of people who would sort of challenge that and say, well, no, the tide has turned on the labour market. The demand is clearly slowing, and that's going to continue. And I'm not sharing that view. I'm talking about a labour market that's basically flat at the moment, but gets stronger as the wider economy gets stronger.
But I think also, John, I mean, you'll know yourself maybe, and maybe Nick can comment on this, that the interim, the demand for interim is driven by a number of things. I mean, the last data I saw said that 30% of assignments are coming from, were coming from private equity. But again, what I've heard recently is private equity activity has been quite quiet for obvious reasons, due to share prices and all sorts of other stuff. There's a big interim demand in the public sector, for example, and as well then in the private sector. So Nick, is there anything we can say for the demand for interim that kind of comes out of this?
Yeah, I mean, you talked about a few different sectors there, and they all utilise interim in very different ways. And public sector demand, in my experience, decreases in the lead up to an election, and often balloons post, especially if we end up with a Labour government that usually expands the size of the public sector state. Most of my work is within private equity. We've had not just within private equity, but generally speaking, the M&A market is down quite significantly this year. But I would say most investors I'm talking to who have a lot of capital to deploy and have started, certainly the deal flow has increased towards the end of this year, and you'll expect to see more deal flow next year. Most private equity investors deploy capital in the form of sort of senior contingent labour, interim management consulting resource right at the start of an acquisition, or 2, 3, 4 years in when things aren't going well. And I think the numbers show, that we're going to have some businesses that will recover quickly, take advantage of recovery, and they might harness access at pace to interim consulting resource, and others will have some challenging times and want to make changes. So, I would envisage that through 24, we'll see greater demand for interim management within private equity. private equity use interim slightly differently to the PLC world that use interim management more for project resource. I'm not thinking I will see a significant increase in that. I think the private equity market will likely be the area where we'll see greatest increase. Public sector will be interesting to see because it depends on an election calls, because although you think an election tends to impact activity within central government, it tends to actually impact health, local authorities, and other parts of the public sector market. So I think all parts of that market will have a slightly different impact depending on nature of the sector.
Yeah. Okay, let's see if we can canter through some of these questions. I think you can read Ian's on the screen. Interesting perspective. If I look at the early slides, the comparison was limited by territory and time. For instance, we did not compare GDP growth in the UK versus Asia or in the Eurozone as a whole, where the Eurozone was 3% higher since Q4 2019 versus UK 1.8. Real GDP growth is 0 in Q3 2023. Summary, we may be recovering, but from a very large fall if measured since 2019. Now, let's find a question in there from Ian.
Well, I think if we, and it's a fair point, but if you look at the quarterly growth rates for the third quarter, with the exception of the US, have been 0 pretty much everywhere. It's fair that there isn't Asia on that slide. If you put China on that slide, all the other lines just become the same, because the growth rates of China and India and so on are so large relative to any of those other economies that you'd have to have the scale would look odd. So I think we can only go with the numbers that we've got. Is that the fall since 2019 Q4? People in the UK, largely, the scale of the falls largely reflect the level of restrictions that you put in place. And the economies had the least number of virus-related restrictions, had the shallowest falls in output. But where we are now compared with where we were in the UK is 1.8% bigger now than it was in 2019 Q4. And the other major European economies are pretty much the same. There's decimal points difference between them.
Yeah.
Can I ask a question I'm sure everybody wants to ask, and that is, are taxes too high, Darren? When are they coming down?
Yeah, I think taxes are too high as a share of GDP and also as a share of what they take from people's pay. How have they ended up being that high? Due to fashion fiscal drag. We've had high wage growth and they haven't increased tax allowances. So we've got 5.5 million people paying higher rate tax. And in 2010, there were 3 million people paying higher rate tax. So we've dragged a lot of people into higher rate tax through freezing allowances while pay's been growing quite quickly. And, that's good for tax receipts, but it does leave the economy with a bit less to grow. But I come back to the point. If your budget deficit is sort of 3-ish% of GDP, which is its average, and you want to cut taxes as a share of GDP, then you have to cut spending as a share of GDP, and that's why it's proven to be difficult to do, because increase in spending it would happen through the pandemic, and the US has got an even bigger problem with this than the UK has. And once you've increased your spending, it's a bit tricky to get it back down again.
Yeah. So look, I'm looking at Gianfranco's question, which of the key trends play the most significant role? He's saying in consumer confidence. I would maybe expand the question down to look at business confidence as well. Or is confidence driven by the headline on the front of the Daily Mirror, or other quality newspapers also available? So what do you think on that one?
What I've learned over quite a bit of time of doing this is that you've got to look at what people do, not what they say.
Yeah.
Because what they say can be highly volatile and can be driven by what's on the front page of the papers, but what they do can be something quite different.
Yeah.
So that's not to say that confidence isn't important. Confidence is very important, but that doesn't mean to say that we can measure it.
No.
What do you think drives consumer confidence, drives consumer spending?
I think the highest correlation between consumer spending and anything is real incomes. Real incomes and real spending, not surprisingly, are very highly correlated. So if you have periods, if you go back over long periods of time and look at years when real wages have gone up, you will find that far more often than not, the economy will be growing if real wages are growing. So it's a good sign and a good indicator if you're confident that the real wages of the household sector are actually going up. If they're going down, then you're relying on less saving. And you can't always rely on that.
Yeah. And of course, business confidence, especially in the highly kind of analytical space of private equity, is driven more empirically, where I would argue potentially or postulate, maybe not argue, that consumer confidence, I mean, coming out of pandemic and then straight into, geopolitical turbulence, wars in Ukraine and what's going on in the Middle East, and then at home with this kind of, coming up to an election and the debacles we've seen with our own political situation and all the chatter, may affect confidence, in different ways.
I think that's right. Business. If we looked at business investment, up until there was a drop in Q3, but up until Q2, business investment was the highest share of GDP it's ever been. Now, that's because the government has put incentives in for companies to invest, policy measures, and if those policy measures are withdrawn, then investment would fall back, and we'll have to wait and see whether those measures are withdrawn or not. But often, I think I come back to what I said before, if you've got 10% inflation, you're going to struggle to encourage high levels of confidence when inflation is that high.
Yeah.
So you've got to get the inflation down to the numbers that people more normally associate with, and where they're not on the. It was interesting, those numbers yesterday didn't get much media coverage. So it's been the government's number one policy priority for a good time now. It was achieved yesterday and got very little coverage. But when inflation got to 10%, it was all people were talking about.
Yeah. And in fact, on that, Xavier's question, is the relatively higher inflation level in the UK a byproduct of the generous furlough scheme during COVID, or indeed, extend that question to the printing money?
Well, most countries intervene. You can't ask people not to go to work and then not pay them.
Yeah.
So once you've decided that you don't want a large number of people to go to work, excuse me, then it's going to cost you a lot of money. It's unavoidable. Because if you hadn't have done that, you would have ended up with a much worse outcome. I think the whole printing money thing is it's often presented as though they printed money, but what actually happens is they issue central bank reserves.
Yeah.
And that represents a loan from the government.
Yeah.
And the bank and the asset purchase facility pays an interest rate on that loan of bank rate. So in effect, they borrowed money at 0.1%. They bought government bonds paying 2.5%, and they made a lot of money. Now they're paying 5.25% on that loan, and it's a big loan, and they're losing. They're making losses. Now, as you'll know, the Treasury indemnify those losses. So there's two sources of gains and losses. There's interest rate gains and losses, and there's valuation gains and losses, and the Treasury indemnify both of them. But the losses that they're making, you've got to remember the gains that they were making before. So over the whole length of of what they've been doing, they'll roughly net each other out.
Yeah, that's interesting, isn't it?
And you know, I've written about this.
Yeah, yeah. I mean, so will we go back to a QE?
Look, I think that whether you agree with it or not, I think the Bank of England's been pretty clear. They want to shrink their balance sheets.
Yeah.
So they're going to continue with their program to make their balance sheets smaller. And you know, for a while they were doing that at the same time that they were raising interest rates. Now they've stopped raising interest rates, but they're continuing to shrink their balance sheet.
Yeah,
I think they will continue with that. No, I think we won't go back to QE in my view, because we've got a starting interest rate of 5.25%. So if the economy cuts up rough and ends up in a very different place to what I've been describing, then they'll cut interest rates. They've got plenty to play with. Yeah.
Yeah. So look, Jen's question then, I think is probably related to that. PPT, I don't know what he means about PPT, and projections are silent on relationship between money markets, debt and QE. Maybe he means your slides, the PowerPoint, and the geopolitical risk around oil prices from widening conflict in the Middle East, and also BRICS de-dollarization and their impact on interest rates. Any views? Can you comment on that?
Well, there's quite a lot going on in there.
Yeah.
I think on I think I mentioned that the market is constantly changing its mind about interest rates. So 1 week you can think they're going to 6.5%, the next week you can think they're going to 4.5%. So excuse me. So I think we just have to sort of accept that. I tend to think I think about it as that it's between 98 and 2007, inflation averaged 2%, bank rate was 5%. Between 2010 and 2019, inflation was also about 2%, and bank rate averaged 0.5%. So we're talking about, we want to have inflation at 2%, bank rate on average is probably somewhere between 0.5 and 5. Maybe let's call it 3. Somewhere around 3%, that's maybe what bank rate averages. So at 5.25, we're well above that average, and at 0.1, we were well below it. But we need to think about, the time path by which that is realised. I think is it's not possible to predict it.
So look, I'm going to try and get through. The last of the questions here. One here from Chris, who's rephrased his original question. He says, SMEs, the lifeblood of the UK economy, are currently paying down loans and overdrafts. So 2 assumptions there. Are they the lifeblood of the UK economy, and are they currently paying down loans and overdrafts, i.e. they are putting investment and business development on hold? So some assumptions there from Chris. How can this be addressed, and what support should we look for specifically for SMEs? Any view on that one?
Well, I mean, I think they are, what makes up the economy, because the economy is made up of hundreds of thousands of companies who individually employ a relatively small number of people, and that is the economy.
Yeah.
And if we look at the data on that, then yeah, I mean, they are. We're seeing negative growth rates in loans and deposits with non-financial corporations. So that is what the data is telling us. So that is what he's describing is what we're seeing in the numbers.
Yeah, and how can this be addressed, and what support should we look for specifically for SMEs? And that's a policy question, I guess, rather than an economic one.
Well, I think, again, it comes back to, because there are such a large number of them, it's quite hard to, it's quite hard to, and this was a problem during the pandemic, to sort of prescribe policies that can be beneficial for all the companies in that universe. So you have to really try and sort of set the framework within which the economy overall operates. And that's why I think regulation is important, because it is like a tax. And you know, you can end up over-regulating the economy. And if you over-regulate it, then you know it won't deliver as much growth as it could do.
Okay, so look, I'm conscious people are starting to drift, and this has been a lot to take in. Final question then from Alan. Lots of it was spent on homeowners and mortgage owners. How do you perceive the outlook for the bulk of people who are renting?
So if you look at the numbers, so at the moment we have about 9 million people with a mortgage spending, call it 100 billion a year on mortgages. And we've got about 6 million people private renting spending 80 to 85 billion a year. So the numbers are not dissimilar, because the average mortgage payment is about £700 a month and the average rent is £1,100–1,200 a month. So on average, people are spending more on renting than they are on buying a house. So now the mortgages generally refix every 5 years, rents reset on average every 14 months. So the increase in rental payments is actually quite material. Rental inflation is running at about 6.5%. So that's across the stock. On the flow, it's a high number than that. So it's very relevant. And of course, when you're putting all your numbers together, you've got to put that in. You know, you've got to look at what's happening to private rent. You know, rent is 8.5% of the CPI basket, which tells you how big it is, because food is about 10. So it's a big component of the basket, because we've got roughly 6 million people private. 20% of the housing stock is private rented, which is quite different to what it used to be. So that is a headwind. Rising rents definitely create a headwind for the economy.
Yeah. Yeah, and of course, with as we discussed earlier, if buy-to-let landlords are exiting and people are not building houses, then the pressure on rents is upwards, isn't it?
Yeah, if you're, you know, it's an interesting question. You know, and this comes up a lot. If we're going to see people exiting the buy-to-let market, is that going to increase home ownership if that property gets sold to a homeowner? So are we now looking at this could be one of the mechanisms whereby we grow home ownership through shrinking private rented sector as people exit it as landlords? And I'm sure there's going to be an element of that happening.
Yeah. Okay, so look, we've got to the end of the questions, I think. Andrea, just saying thanks very much. More encouraging, and I think we've had a number of people who have said, Darren, that the presentation gives more upbeat vibes than most people, I think, were expecting, and I think that's similar for me, and it's reflected in the poll as well. It says that 54% of the respondents say that that there'll be more demand for interim execs in the next 12 months. And it's interesting that out of the audience, 20% say they're on assignment, 80% say they're not. But in 2024, 97% expect to be on assignment. So a big turnaround in sentiment there, which I think is interesting. And also that they say that 63% say that there's going to be a more positive effect on day rates, Nick. So that's encouraging, I think, for everyone. So just some closing remarks, Nick. Do you want to come in and just give us a couple of minutes, maybe on McLean and just what words before we close?
Yeah, thank you. I mean, first of all, just to say thank you for everyone who attended. A huge thanks to Darren, who provided some really insightful analysis as ever. Our reflections on the market have been that it has been relatively reflective of the numbers we've just seen. It has been a quiet summer in terms of executive recruitment activity, but we're seeing the numbers increase towards the back end of the year, and so we're hopeful that the numbers we're starting to see as we sort of exit 23, demonstrate a similar pattern going into 24, and we have a recovery through 24. So hopefully we're all seeing the early stages of that.
Yeah. Well, look, super. Dan, thank you enormously. That was absolutely fascinating. On behalf of the IIM and all the attendees, I think everybody's taken loads away. Great session. Nick, thank you for organising it. Enjoy the rest of your day, the rest of your week, and hopefully when we rerun the session, which I hope we do, we'll see how some of these predictions have played out, Darren.
Yeah, absolutely. Get you the
All
slides.
right. Thank you very much.
Thank you all.
Thank you.
Bye-bye.
Bye now. Bye-bye.